Welcome to another edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth, and today we will be discussing with Phil Cornet, portfolio manager of Atlas Equity Income, the current macroeconomic landscape and the competitive advantage of his equity income fund. Now, welcome, Phil.
Great to be here, Rob. Thanks for having me.
Great to be here chatting with you, mate. Now, before we do get started, however, we do need to touch on the general advice disclaimer. Anything that Phil and I discussed today is general advice only. Anyone acting on that advice without written and agreed consent from a financial advisor, someone like myself, does so entirely at their own risk. Now, Phil, we have known each other. I looked, it's been more than 25 years we've actually known each other. We started working together in the Melbourne office of Citigroup back in 2000.
A long time ago, but yes, I think we both had a little bit more hair.
Now, Phil, tell us over that 25 years how you've got to where you are now.
Yeah, I've been on the institutional broking side or the funds management side for over 25 years. So I've probably got a year or two on you there, Rob. But yeah, so obviously Citigroup was a great time, a formative time. I left Citigroup to go to Lehman Brothers. Again, was a huge learning experience and something I still value. And then I've had 10 years of perennial value. On the funds management side, I opened an equity income fund very similar to this strategy that I'm currently doing with Fortitude Capital, who are a very successful hedge fund in Australia. So yeah, wide, extensive experience across Australia and equities and equity derivatives.
Let's go back to that Lehman moment. Tell us about what your learning from that experience was.
Humorous is probably a great place to start. It was a massive learning experience, and I went from being a cog at Citigroup to basically being the whole wheel. We had a very small office in Sydney. They were playing double up to catch up in the MBS space. That was the new fantastic place where everyone was monetizing and packaging mortgages to putting them out and selling them to investors across the world. Lehman's were probably late to that game, and they played double up to catch up and got found out, as did most other US investment banks, mind you. But they were the ones very much like Ben Johnson in the 1988 100-meter sprint Olympics, the only one that was caught, but there was probably a few others that were guilty in that final.
Yeah, no doubt. Now, looking back at that period, I must admit I learned a lot as well. And you and I are big believers in macro. We love reading about it. We love discussing it. What are some of the similarities you're seeing at the moment between those two periods? Are there similarities, or what are some of the concerns you've got at current market environment?
I think that's important, that it's different this time is treated the way it should be. We're coming through a very interesting phase right now with artificial intelligence. We've come through, this is a new technology. It's going to be amazing, and it will be. There's no doubt. Robotics is probably catching up very quickly. So it was very much like the tech wreck of 99 at the very beginning of our careers, and we were somewhat isolated in Australia, didn't have much of a tech wreck here at all, but there was some major innovation, but there was also a lot of people chasing that and following that innovation, and multiples get stretched. And we see this with every bubble that through the history of time, people in financial markets look to monetize the story of the day. And I think we're in a similar spot to that now, different. For instance, the banks are a lot more, the regulatory environment increased for those guys after the GFC. So the balance sheets of the banks are a lot better than they were back at 2007, 2008. It comes up in a different form. And for me, that's the private assets, private credit, private equity is where I see some similarities perhaps with that 2006, 7, 8 period.
Yeah, okay. Let's get into that because we want to talk a bit of macro. So tell us your view there on private assets and your concern.
A big warning for me anytime I hear it, and again, it pops up in bubbles, is, we're giving you the opportunity to participate like an institutional investor, the democratization of a product. And we've seen that a lot over the last 2 or 3 years, which has seen a huge increase in what they're calling the shadow banking system. The banks were basically regulated out of some of that lending. They've got replaced. So there's been other shops that have taken up the mantle. Banks out, we're drowning in a sea of liquidity. We have been since the emergency measures of central banks around the world from the GFC. The short-term emergency measures have lasted 16 years. We've got rates at a very low level compared to the history would tell you that where rates are now, they're low. We've got a lot of liquidity. When there's so much liquidity, people find ways to package it together, invest it, and private credit and private debt have been two industries that have exploded. And I think they should have come with a larger warning sign. And a very big warning signs to me is, we're going to democratise private assets for the retail punter. That's a warning sign to me.
Yeah, and you spoke about cheap money or low interest rates. What's your view there? Is that just exaggerated the money flow into private credit looking for a return?
Yeah, definitely. And I call it the only game in town. It's been the only game in town since the Federal Reserve took very unconventional policy and effectively put rates to zero. We saw Japan do that at the early 1990s on the back of a real estate bubble there that took them 40 years to get out of. I fear that low interest rates causes more problems than it solves. So we've had extremely low rates since basically 2009, 2010. Every time there's a chance of increasing rates, you see a lot of asset owners start to squeal. We've got asset bubbles, whether it be real estate, you can translate that into a housing crisis or housing affordability crisis. That's happening around the world. You've got things like crypto, you've got things like share markets trading at multiples by historical remains. That only game in town, which is a flood of liquidity, it continues. What we saw out of COVID, where the liquidity got ramped up yet again on a scare, and then we've seen the Ukraine-Russian war, suddenly inflation's popped up. And it's been surprising to me over 15 plus years of low interest rates that inflation hasn't been hit, And I think inflation is a worse prospect to look at, sustained inflation, than perhaps a recession or a couple of quarters of low growth.
Yeah. And in your opinion, do you know, or do you have a view what's caused this higher inflation rate? Is it a function of cheap money and fiscal policy?
All of the above. And since we've seen the bifurcation of the world sort of trade order, which Trump has brought to the table less than 18 months ago, the world's becoming a larger place again. We've had 30, 40 years where the world was becoming very small. Everyone traded with everyone. It feels like we're going into a period where there's going to be blocks again. And tightening up the pipes of world trade can only be inflationary. So I think there's a few factors that have contributed to the inflation, but I think there is inflation nonetheless. And I think the market is maybe underestimating that inflation.
Yeah, I can't disagree with you there. So let's talk about a bit more stock specific now. You've commentated for a while around stock dispersion, which means how much stocks move up and down and the gap between those moves. But also following reporting season, you also commentated around those moves in that period. Can you give us a bit of a summary of reporting season and then some of the key takeaways from how much the stocks moved up and down thereafter?
Yeah, so dispersion over the last two reporting seasons in particular has been enormous. And what I mean by that, and actually year-to-date returns on 2026 are a good example. So far from this morning, the ASX 200 is basically flat. It certainly doesn't feel flat. Depending on if it was this time last week, you'd be saying the market's rampaging away. Today we're flat. Early Jan, there were a couple of warring periods. So you've got stocks within that index that are up 30% or minus 30%. You have a look at where Woodside is. You have a look where BHP was up 30% or 28%. It's now, it gave a fair bit of that back this week. And then on the other side of those stocks that have been rampaging upwards, you've got others that have been absolutely smoked, whether that's been Zero, Seek, Cochlear, for instance. They're all down close to 30% year to date, and we're only 2 and a bit months in. So that dispersion is, you've got winners, or the haves and the have-nots, as I like to call it. And if you're totally removed from watching any of the constituents that make up that index, you're probably going, oh, the market's humming along. It's really low volatile. It's definitely not that.
But
So reporting season is quite strong overall.
some of these results, like Cochlear, for example, was it that bad? Was the result that bad where it deserved to be down that much?
Healthcare as a sector has been on the nose. I can't speak to Cochlear that much because it's not a holding of mine and it'll probably never get into my equity income fund. But conversely, CSL is, and they've had 3 downgrades that has probably contributed to about a 13 or 14% earnings downgrade since August. The stock's halved. So this is, I think, leading to this increased dispersion, and dispersion is measured by a lot of the investment banks and the derivative trading desks around the market, and dispersion's never been this high in certainly my career in markets, 25 to almost 30 years.
Yeah, okay. And then I know you shared a chart with me earlier around volatility. Now I had a look, and obviously the volatility in the GFC was very high, but you look over the last 3 or 4 years, actually similar levels of volatility. Is this dispersion or just passive money? What's causing this volatility?
It's very reactive. And the one thing I'd say about the volatility, it seems to be a lot shorter lived. Like you see a spike, it disappears as quickly. Market in that used to be, it takes a while to get to the top, but you can you can have that correction, that fall very quickly. I'd almost say it's reversed, where it's down by the stairs and up by the elevator. The by the dip mentality is ingrained in a whole new, I suppose, generation of asset managers, traders, and risk managers. And the belief that you buy the dip is proving to be correct. But after many years of watching trading and going through the odd crisis here and there, I'm a little bit more circumspect. And at some point, the buy the dip trade is not going to work.
Yeah. Feels like the stock market's now being used as a bit of a punting machine rather than the investors or long-term investors.
100%. And again, that dispersion that we're seeing and that over-exaggerated reaction to a result, whether it's good or bad, I think proves that. And again, it's the move to passive investing, the increase in quant investing, the re-emergence of hedge fund pods, which are very momentum-driven and thematic-driven. So you can have a 2% earnings downgrade and the stock can fall 10% and vice versa on the upside. And at some point, the stock market will become the weighing machine again. At the moment, it seems to be very much the voting machine. And again, I'm pulling out an old saying from market days, but short term, it's a voting machine. Long term, it should be a weighing machine. And that's where my focus is on stocks that actually have earnings that can pay dividends and over the long term should provide a much more smoother ride for investors, but also a much more positive ride for investors than buying whatever theme of the day.
Yeah. Now we're recording on the Tuesday, 10th of March. Yep. And we saw yesterday, Monday, the share market fell 3%, one of the biggest falls since Liberation Day when Trump announced all of his tariffs. That was some big moves. So how does someone like yourself, Phil, look at those voting machine days on the down? How do you become opportunistic to stabilize the portfolio, look for opportunities? What do you do in that situation?
That's very much the aim, is to be opportunistic on those days. If there's a stock that you've been looking at, liking, perhaps it's been too expensive and it gets caught up in a sell down line, you step into the market. And again, this time yesterday, I think the market was down 4% and it rallied into the close. You don't want to be jumping in front of the train, so to speak, but you certainly should be trusting the work that you've done and the stocks that you like that you've lined up. You should be participating. So you're not going all in on a day like tomorrow, because who knows? We could have seen a similar result to where we were at midday yesterday in the States overnight, and we would have been down a further 2 or 3%, which again gives you the opportunity to step into the market, nibble away at stocks that you like, stocks that you think represent good value, that are yielding. And particularly at those levels, the yield starts to increase and they start to look a lot more attractive to an income-focused investor like myself.
Okay, so let's expand a little bit on your fund, the Atlas Equity Income Fund. What's its purpose and who's your target audience?
Yeah, the purpose is to harness yield, basically. So there's many ways you can get that from various asset classes. The Aussie equity market is been pretty much always a very good yielding market. It provides a higher dividend yield than most equity markets around the world. It also provides franking for an Aussie investor that can be quite meaningful. And franking's actually got a little bit harder to find post APRA's decision to effectively close down the bank hybrid market, which was a very popular way of receiving higher than cash rate income that also came with franking attached. So I'm looking at harnessing yield. I'm targeting somewhere between 8 and 10% per year. And everyone goes, how do you manage that out of the equity market, which typically yields about 4%? Currently, on the high multiples that it's at, it's yielding circa 3.3. It involves using a buy right strategy. So in my time over the years in Aussie equities and Aussie equity derivatives, people that are natural holders of stock should be earning some additional income from selling options against that portfolio. So typically I'll explain it that I'm looking for a higher than ASX 200 market dividend yield. So I'm typically looking for 4 to 5% dividend yield. That's before franking. So gross that up and you're looking at close to 6%. And then accessing the derivative market to achieve another 4 to 5% yield. But again, that's in a perfect market. And with the market rampaging like it has basically since the post-Liberation Day tariffs from Trump, it's difficult in a buy right situation to keep up with a market that's rampaging like it had from April through to about December. But yeah, that's basically the gist of on trying to deliver a 10% yield per annum with franking and significantly lower volatility than the Aussie equity market, because that's the concern of the income investors. They don't want the volatility that comes with equities.
Can you elaborate a little bit more on that? Because what's the competitive advantage of your fund over like a Vanguard high yield fund? What's the difference?
The difference is definitely the lower volatility. So my fund, we've got index protection over the portfolio. That's us buying puts. It comes at a cost. So it eats into that yield, but we're still confident that we deliver circa 8 to 10% a year in yield. Currently, we're delivering about 7.5%. So the stock standard equity income fund won't have that protection overlay over the portfolio. They will reflect pretty much the equity market volatility. My fund's roughly half. So it's all about that low volatility providing smoother returns. So to go back to who's the target market, very much the SMSF investor, very much the retiree, and for that matter, also to not-for-profit organisations as well, who can also utilise franking and also require additional income every year. So that SMS investor, the last thing they need coming into the drawdown phase of their investment is a drawdown in the equity market where they may be heavily invested. So if you have $1 million balance in your SMSF and you have a good portion of that, say 50%, which would probably be too high, then it's certainly above where you'd be nominating Rob, I know that, but just to make it easy with the numbers, if you've got $500,000 in Aussie equities, happily taking the dividends, happily taking the franking, and it's down 30%, you're suddenly down a fair chunk of money in a relatively short space of time, just when you're looking to take some of that money out to go on the overseas holiday that you've always promised yourself, or buy that holiday house where you're looking to retire. So it's about taking out some of that risk that equity investing can come with.
Yeah, so you manage the risk, you continue to pay the dividend. So anyone that's self-managing their own super fund that tries to pick the banks and insurers and Rio and BHP to pay out dividends and part that obviously franked, you're managing that volatility. So when you wake up or you go to watch the news that night, the share market's down 2%, your portfolio should be falling 2% because of your protection around the buy right strategy.
Correct. And that's what we generally say. In a market where the market may be up 20% for the year, we're not going to reach that 20% mark. We'll be hopefully somewhere between 10 and 15% to the upside. But if the market's down 10, 20%, we'd envisage that it'd be minus 5%.
Yeah, and still paying that dividend.
And still paying, at the moment, we're paying 7% per annum before franking in quarterly dividends, quarterly distributions of 1.75%. And over time, I'd envisage that that will rise circa 2% per quarter.
Yep, great. Now, you've put this portfolio together to manage all this, the income and the capital stability. How do you actually identify stocks?
So the team here at Atlas, there's 3 of us. So Hugh Dive kicked off Atlas a number of years ago now, and we've got a young analyst by the name of Michael Haynes. They've both been in the markets for long enough to analyze stocks really well, and she's got similar experience to me. But he's an analyst. I'm very much not the stock picker guy. I'm not the analyst. I look at myself as the portfolio manager of the Atlas Equity Income Fund, as a risk manager. So we look at it in two ways. We start off quantitatively, where I am looking at the whole ASX 100 basically to ascertain what stock can potentially pay us 10% per annum. And again, there's that long-term target of every member of the portfolio providing 10%. How do we get there? Dividend yield, and then the premium yield that we're going to get from the option market. So looking for 4 to 5% dividend yield, and then 4 to 5% from the option market that we're writing options against. So writing that options via the buy right strategy, we're effectively getting rewarded for selling away some of the upside of the portfolio. And that's how we come. I look at every stock in the ASX 100, mostly because they're the only ones that are paying dividends, and mostly because they're the ones that have franking attached. Well, and if those stocks can potentially provide 10% yield, they're into the mix. And then we put a qualitative overlay on top of that, where I rely on Hugh and Michael to give me a view on those stocks. And again, I'm probably more worried, as long as the dividend is secure and the earnings is relatively secured, I'm more worried about a potential blow up than I am a stock rampaging and doubling earnings. If I can get a stock that's up 8-10% a year, that's paying me 5% a year dividend yield, and then I'm picking up 5% in the option market as well, I'm a happy camper. And again, that brings down that volatility of returns as well. After all of that, I've gone through the top 100. We've had a quantitative overlay. We've gone into the qualitative stuff. If they tick the box, they're then into the mix to get into my portfolio, which is roughly somewhere between 20 and 25 stocks. I also, as I said, I'd rather manage risk than try and tell you I'm a stock picker and pick favorite sectors, favorite stocks, favorite sectors. I cover, or ensure the portfolio covers, each gig sector. So I don't want to be overweight banks and underweight resources and then have resources run and banks fall. So I'll be represented in banks, I'll be represented in resources, I'll be represented in telcos, I'll be represented in healthcare. I wish I wasn't represented in healthcare, but that'll turn around. I try to cover the whole spectrum of every gig sector so that I'm not taking sector bets or sector weights. I pick the best stocks within that sector that are paying me good dividends, preferably franked, and then that's how I put the portfolio together.
So it sounds like you are trying to replicate the ASX 100 by picking ASX top 100 stocks. You're paying out dividends greater than the market, and you are providing less volatility in the middle. Your fund is not going to rise as much as the market when it rises, but it's not going to fall as much as the market when it falls. So you're giving that constant dividend distribution, some growth when it's there, but you provide that stability for those people that are looking for that as part of their strategy.
100%. And I quite proudly say the portfolio is boring, and it's meant to be.
Boring is good sometimes. Now, you mentioned earlier, you spoke about dividends rising by around 2%. I believe that probably be a function of earnings growth as well, which ultimately drives dividend growth. Can you give us a view on the outlook on your view on the Australian share market, and why should investors consider Atlas as part of their portfolio?
Yeah, I think despite the news headlines, despite productivity concerns and potentially tax policy, Australia is a great place to be. Great place to live. It's going to have population growth. I think economically, Australia on a long-term basis looks extremely attractive. It's an attractive place to invest. Geopolitically, you've got to take that into account these days. Australia is a stable place. Australia looks attractive. I think the dividend yield that the Australian market consistently provides looks attractive. For tax-effective investing, franking is one of the, in Australia, it's one of the few places that you can actually get franking. So, yeah, I think the market outlook is relatively strong. The beauty of the Atlas Equity Income Fund is its boringness. is its ability to continue to pay down regular distributions and provide income for people that are looking for it.
Yep, great. And Phil, if anyone wants to learn a little bit more about the Atlas Equity Income Fund or yourself, where should they go?
Obviously onto the website, Atlas Funds Management, or you can contact me direct. I'm happy to speak to investors. It's not about going right all the time. It's just being less wrong than most and participating in the market. And that's what I'm always doing, is making sure that the eyes are on the market, the eyes are on the portfolio, and that the income targets are being met, because income's important and earnings matter.
Fantastic. Phil, thank you so much for your time, and all the best for the next 12 months, I suppose, and more.
Yeah, thanks, Rob. It's great to be on a podcast with you and Mont.
Cheers, mate.
Cheers.